Thank you to the organizers for including us. Also, the 10 a.m. start is fantastic on a Saturday. So this is co-author works with my long-term co-author Steve Dimmick. I also have Tyson Van Alphen, who's a PhD student at the University of Kentucky, who's on this paper, and he's on the job market. So in this paper, we're going to ask this question: do household-level financial shocks cause professionals to engage in financial misconduct? And specifically, probably to this audience, it's interesting to see, whether financial advisors, who is this important conduit for a lot of households to invest into markets, are there incentives for them to treat their clients poorly or take advantage of them to create short-term gains when these financial advisors themselves are under financial pressure? This also goes to a bigger literature, though, on really what is this relationship between wealth and crime and misconduct? I mean, this is an age-old question. It goes back to Aristotle, who called poverty the parent of crime. As you might guess, with many age-old questions, it's really hard to answer, else it wouldn't be an age-old question anymore. And so, there's a lot of kind of correlation between poverty and crime rates, but it's, for an empirical setting, it's really hard to tease out kind of confounding factors there. And it turns out that the theory does not give us unambiguous predictions either, and a lot depends on how we think about misconduct and that type of activity. On one hand, we could think of misconduct, in this I mean, something like a financial advisor goes and churns their client's assets. It's something that's not good for the client. It creates a short-term gain for the advisor, but it also puts the advisor at risk for being terminated and fired and reducing their labor income. So it's essentially a risky activity from the point of the advisor. I can have a little bit of short-term gains by engaging in this, but I could also lose out. And so it increases the volatility of my payouts. And Egan Matthews-Saru document, there are reduced labor prospects for those advisors who are caught engaging in churning their clients' accounts, providing unauthorized trades, these types of issues. But in other domains, we see personal wealth shocks do affect risk preferences of risky activities. So there was a recent paper looking at mutual fund managers who suffered wealth shocks to their primary residence, and they saw that these mutual fund managers actually took less risky positions in the portfolios they managed in response to these wealth shocks in their housing wealth. Bernstein, McQuaid, and Townsend have a paper where they look at innovation by employees, and they show that these inventors do less innovative work when they're subject to these wealth shocks. Again, they suggest this is a risk story. Essentially, people tend to take less risk when they have less wealth, and that's consistent with this decreasing absolute risk aversion. And if you actually go back to the original Becker Economics of Crime paper, he actually addresses this, and he shows that if you put in a constant dollar value for the value of your utility of ethical behavior, that essentially when you suffer a risk, a negative risk shock, you're less willing to, or a negative wealth shock, you're less willing to take risk, and you'd actually have less misconduct. And so wealth is positively correlated with your misconduct. Now, what does this theory assumption mean? It means that if I'm unwilling to steal a loaf of bread when I have a relatively comfortable salary right now, it also means that even if I was destitute, I would be unwilling to go out and steal a loaf of bread to feed my family. And so that's not a very kind of comfortable assumption. And so once you endogenize, or once you allow essentially the economic value or your utility value of ethics to vary with wealth, this essentially creates ambiguous predictions, and the models just don't give clear predictions between how wealth and crime might vary. Other fields have looked at this as well, and so there's a classic study in criminology where Cressy went out and interviewed lots and lots of white-collar criminals, people that were convicted of embezzlement, and he found that a precedent in most of these cases were some sort of financial pressure. So Cressy's finding somewhat the opposite here, that when you have higher levels of financial pressure, these people are the ones that go and engage in embezzlement. But of course, these types of studies are problematic because a lot of the things that lead to this financial pressure, things like gambling, drug abuse, alcoholism, and reckless spending. And unlike Barry's paper yesterday, we don't have kind of exogenous distribution of gambling problems. Well, lottery winnings might be exogenous, you could argue. Gambling problems are not exogenously distributed. They're correlated with a lot of attributes of people. And so people don't just one day say, hey, I just want to get a drinking problem, or it just happens. It's correlated with a lot of other factors that might be related to their ability to hold employment, to generate wealth. And so essentially, for the empiricist, it creates a big challenge, right? How do we separate out these two things? And oftentimes when Steve and I started a project, we go, what would the ideal experiment look like? And so here's what I have in mind for the ideal experiment. Essentially, you'd want to take a well-to-do broker or financial advisor, right? And then just kind of arbitrarily take away his wealth, right? And then observe his behavior and see what happens. And given the chuckles, at least some of you guys realize this is basically the premise of Trading Places, right? And so in this 1984 comedy classic, essentially what happens, the Duke brothers decide to test nature versus nurture by randomly kind of planting drugs on Louis Winthrop, taking away his job, and then seeing if he resorts to a life of crime. Now obviously, N=1, it's a movie, we can't really write that up. Needless to say, when we went to IRB, they said we can't do this either. And so we need to try to figure out what is the closest way we can get to this in observational data. And so what we're going to do is we're going to appeal to the collapse of the housing bubble as our exogenous shock. Housing wealth is a big fraction of the typical household's wealth. It's been shown that when the housing prices collapse, there's a reduction in consumption, even for those households that aren't refinancing or for facing bankruptcy. The other factor is that it seems that the housing bubble was at least largely unforeseen. There's a really neat paper where they look at securitization managers and their own real estate transactions. And there's no evidence that these securitization managers were avoiding this bubble. They were buying higher and higher price houses before the bubble collapsed. And so, hopefully this is a pretty large shock, a meaningful shock that's going to change their behavior, and also something that's relatively unforeseen. So if this is the experiment that we're going to use, our laboratory is going to be the financial advisory industry. Financial advisors are an important financial intermediary. There are over 500,000 in the US. And part of the reason why the industry is so large is financial literacy isn't that great. And also a consequence of that is it also means it's very hard for a lot of the clients of financial advisors to monitor them well. And we have essentially kind of classic kind of creed is good problem here. Couple that with the high-powered incentives that are typically employed in an industry, and not surprisingly, there's a lot of opportunity for misconduct. So, a lot of opportunity where clients, see their assets getting churned, being put into high-fee products that aren't right for them, these types of issues here. Another wonderful factor about the financial advisory industry is the data is incredible. The regulatory requirements allow us to track advisors, their residences, and their conduct over time. So there's this CRD database that's maintained jointly by FINRA and state regulators that has the histories of about 1.3 million financial advisors over the past couple decades. What's really nice about this data are their unique identifiers for individuals and for firms and branches. Go ahead.
These are not SEC registered, they're FINRA registered, so they're broker-dealers, not advisors.
So you're half right. They are FINRA registered. A lot of them are also jointly registered with the SEC, but we're not looking at any SEC only, which is actually a pretty small fraction. Most financial advisors, largely constructed, are either straight brokers or they're dual brokers, registered investment advisors. And so one of the nice things, because they're registered with the states, FINRA you can't write FOIA requests against, but the states you can actually write FOIA requests, and a lot of states will provide you the data. So what I do is I obtain detailed data on the employment history, so I have start and end dates for all these financial advisors. I know the incidences of misconduct. Like I said, these are typically things like churning. I'll have some information about the customer. I'll have alleged damages, settlements. I'm only going to keep incidences of misconduct that are adjudicated either through the arbitration process or when there's a large settlement paid out. And then, very interestingly, I have the work address of all the employees throughout time and also their residential address. So I'm going to be able to track these people and see what's going to happen to the kind of the value of housing in their residential zip code. And it turns out, and I was telling somebody and they were a little bit surprised about this, about 5.5% of advisors have at least one violation, one of incidents of misconduct during their career. There is a lot of recidivism. It clusters also geographically. There's a lot of kind of factors that we're looking into, and we'll have to address that. And as I said, most common things are unauthorized trading, churning, misrepresentation. From the advisor's point of view, these are things that are going to generate me a small amount of commission or fees, right? I'm doing these actions because this gives me a little bit extra fees, more than I would have without these types of actions, but they also put me at risk of getting fired. So for substatus states, FOIA responses varied a lot, but I think it was about 13 states gave me the residential data. Now, one important thing to understand, and this goes back to like who's registered with whom, a financial advisor who has a client in Florida, even if they live and work in Kentucky, has to register with Florida. And in fact, for a lot of large firms, they'll register with all 50 states so they can take clients from all 50 states. So even though we only have about 13 states, because we have large states and we also have kind of retirement states like Florida, we get a lot of coverage of the universe of financial advisors. Turns out we have over about 1 million residences. Another important thing to understand is that the residential history has both a start and end date on it. So a lot of these residences start before they move into the industry. In fact, because a lot of people go into the industry right out of college, we can trace a lot of these people back into the home that they were born in if they didn't move around a lot in high school. In fact, for this financial advisor, you can see him born in Cypress, Texas, going off to college at Texas A&M, if you know where College Station is. He actually had to move back home for a semester, and then he goes and enters into the industry. So it's really detailed data. We can track these guys around, understand kind of where they're living. Now, let me kind of talk about a couple of shortcomings. One, we don't have detailed price data for all these residences, right? I don't think that actually even exists. So we impute prices from the residences using the Zillow real estate zip level data. There's also some other zip code level indexes that we use. We also looked for a subset of how closely the Zillow house price matched the Zillow zip price. And since we're trying to get time series shocks, it actually does a pretty good job. We're able to identify shocks that are quite correlated. It's, that the levels are not as correlated. And then the other thing, we don't observe whether an individual rents or owns the property. Obviously, that creates a little bit of measurement error. It's not clear that this should be correlated with anything that we're worried about, but something to keep in mind as you're going through the results. We don't have this. We've run this on subsets of addresses where ownership rates are really high, or also on excluding like multiple residence addresses, like office or apartment buildings and stuff, and the results seem quite similar there.
And just to clarify, also when you say you don't know whether they own, you don't know whether they're carrying a mortgage.
No, we don't know whether they're carrying.
That matters.
Yeah. And so, this is probably not a surprising stat for anybody. This is essentially a fraction of advisors who face real estate shocks over time. And as you might guess, in Nevada, they kind of hit the shocks early on. Almost everybody in Nevada ends up experiencing at least a 10% year-over-year decline in their house at some point. There's cross-sectional variation. Texas largely avoided kind of large real estate shock, negative shocks. Some states like Illinois kind of got more of the effect later on, so there's a little bit of time series variation, but most of it's kind of around this bubble and collapse in 2007, 8, and 9. And so, as somebody who does a lot of fraud research, I'm always very skeptical. Let me just show you the raw data before I go and beat it up and run it through all the statistical tests too much. Here's just the raw data. Here's like the first thing that I think most of us would do if you got this data, right? So we just got, what are the zip codes that had the shock? Just put them in event time and just look at the misconduct rates, unconditional on anything. So this is just, what are the misconduct rates, the number of misconduct events per advisor in zip codes that eventually experience a 10% shock in event time relative to that 10% shock. So before the shock, there's basically right around the national average. When that zip code faces a 10% negative decline, we see misconduct rates spike up for a couple years after and then decline. And then you can kind of see a similar picture if you go and look at this if you look at each zip year, bend into what its year-over-year return was. And so for those zip years that have really bad negative returns, we see the highest misconduct rates in those zip years. Starts around 0 and it increases as it gets more and more negative. For positive rates, it's relatively flat and right around the national average. Now, obviously, these are kind of, I think, very, when I saw this, I was like, man, we got a paper. Hopefully we don't break it in the identification process, right? But, there are a lot of things that could be going on here, right? There are confounding factors. Miami has one of the highest rates of misconduct. They also, flashy city, attractive to maybe certain types of people, and so there might be some, but there might be confounding factors between the things that attract people to Miami, misconduct rates, real estate price volatility. All these things could be running on in the background.
You mean direct flights from Bogota?
Yeah. That's our instrument. Gave away. No, but we definitely need control for this. So we're going to look at a lot of stuff like kind of within the same area, within the same advisors to control for all these confounding factors. We're going to do a difference in difference approach around the financial crisis, and then we're also going to expand this and run some panel regressions using the cumulative return since the purchase. So the dependent variable in kind of our difference in difference design is just going to be the change in misconduct in the pre and post period. We're just going to kind of do the standard, we're going to do a 3-year window before and a 3-year window after. Differencing obviously is going to remove any time invariant characteristics of the advisor. A couple of these have been shown to matter, things like gender. And then we're also going to measure the crisis return, say in 2008. It turns out a lot of these assumptions about the windowing don't really matter much. But essentially all we're going to do is get some sort of measure of how much that advisor was shocked during the crisis, and then look at that change in misconduct rates in the pre and post period. We're also going to control for the advisor's experience in the industry, the time at the residence, and firm effects. Remember, in the difference in difference approach, this will actually control for the changes in these things. So like if young advisors kind of reacted differently in the crisis than older advisors. And it turns out, kind of in a simple difference in difference specification, we find a negative relationship between the price change in the crisis and misconduct rates. Now, in 2008, almost all the changes were negative, so essentially those advisors that suffered price drops saw a higher rate of misconduct. Essentially, financial pressure was related to an increased rate of misconduct. To put some magnitudes on this, a 10% drop on the house is related to about a 41% increase relative to the baseline over 3 years. We do the standard type of difference in difference things where we put in a placebo shock of, instead of putting in their 2008 return, let's replace it with 2005 or 2011, and we don't find any significance in those tests. And the reason why we're doing it this way largely follows the existing literature. There are a couple issues. One, the shock doesn't hit all advisors at the same time. Advisors can move and change employer, and this actually happened a lot during the crisis. It only exploits a limited part of our data, and also there's kind of still some identification things that we need to kind of tease out, especially about local clients. So we move on to looking at the cumulative return since purchase. So we know when an advisor moved into an area, we figure out the price of the home then, and we essentially track it over time. So here's Abe and Bob. Abe bought back in 2000. We track his cumulative return in his residence, and Bob moved in right before the bubble. And so when the crisis hits in 2008, Bob is big underwater, whereas Abe is not as underwater and really doesn't become so until later on here. And so two advisors in the same zip code might experience the same year-over-year shock, but end up having different cumulative returns here. One thing that we can do to validate does this cumulative return actually measure financial pressure is that FINRA requires the reporting of bankruptcies and short sales. And so we can use this cumulative return measure and show that it actually predicts the advisor's bankruptcies and short sales. And so that suggests that this measure, with all its shortcomings, is at least picking up, some measure of financial pressure. Importantly, we can track these cumulative returns for each advisor over this panel data. And then we can do similar types of controls like we did in the different setting, doing their analogies in the panel setting. So we're going to put in fixed effects for the advisor, for the time at residence, for the zip code, and for firm year in our test here. And so in the second column, the first column shows it without advisor fixed effects. The second column is the one within advisor. So for that same advisor, when they get a negative cumulative return, they're more likely to engage in financial misconduct. And in the third column, we put in a kind of an interaction for extreme loss. This is more than a 20% loss. It's kind of loosely based on equity. Obviously, it's more complicated than that, but essentially, it's saying that this effect is bigger for the larger negative cumulative returns. Then we go and we say, let's make sure that there's no sort of other kind of mechanical relationship going on here, and we run a placebo test where we take Abe and Bob. And instead of assigning Abe and Bob the returns that they got if they moved into Las Vegas in 2000 and 2005 respectively, let's give them the returns that they would have achieved if instead they moved to Muskogee, Oklahoma instead. So Abe and Bob are very disappointed, and now they also have these different returns here, right? The key thing about doing it this way, kind of doing a complete mapping zip code to zip code, is it retains essentially all the other kind of cross-sectional information. And because we do it basically as a shuffle, we also retain kind of the time series shock that the sample receives as well. So it retains these cross-sectional and time series relationships. And when we do this, we see that the placebo coefficients on this pseudo return are right around 0. None of them approach the coefficient that we actually see in our data. So there's got to be something about that advisor and the returns that they actually receive that's driving this effect. Now, John keeps on bobbing his head. I think you're worried about the local clients, right? That's the other side of this that could be going on. So we want to try to break apart this commonality in the customer and the advisor shock. And so one way that we can do this is look at variation in cumulative returns within advisors living within a zip code and working within the same branch office. So they're very similar in a lot of dimensions, but they have different shocks largely based on when they move in. And so we use residence zip year fixed effects, office branch year fixed effects, and branch times zip times year. So the same advisor working at the same branch office location, these guys go home, they're neighbors in their neighborhood, and we're comparing within these two neighbors based on when they move in, essentially. And we see that the cumulative return effects are relatively similar to our baseline. They're a little bit mitigated, but still on the same sort of order of magnitude here. Now, if you're really thinking hard, it's 10 o'clock, so it's still a little bit early, but you might be worried, well, maybe these two guys that work at the same branch and live in the same area, maybe the one guy that moved in earlier started getting clients back when they moved in earlier, right? And so maybe these clients, the guy that came later, also got newer clients. And maybe so there's some commonality because of the cumulative return of when they got their clients. So to break the possibility of this type of story, we exploit the fact that some of these clients move away and they don't live in the same area as the customer. Now, financial advisors, most of their clientele is locally based, but oftentimes it's the case that clients will move down, particularly to Arizona and Florida, for retirement. And so we break this lock because now essentially these tests are going to compare the misconduct rates on these clients that moved away, say down in Florida, for advisor in Texas versus the one in Las Vegas, comparing their shocks. And again, we see a negative relationship in these types of tests. Another way to do this is let's get away from the customers altogether. So we exclude all advisor years that have any customer complaints, and we say, what about kind of the other actors that are policing the financial advisors, the regulators and the firms? We exclude customer complaints, so we're not getting things that are just kind of the firm punishing the individual for this or the regulators punishing this. But there are things like sometimes the advisors will file false kind of documentation in hopes of kind of generating commissions or false bonuses and stuff against the firms, and they'll get fired for that. And so we'll look at these types of events, and again, importantly, we'll control for firm year and state year effects, the levels at which the firm and the regulators operate, and see even within the same firm year or the same state year, we see that the advisors that have larger cumulative returns or larger negative cumulative returns are more likely to engage in misconduct. And then we look at, well, is there some variation in this effect across a population? And one thing that we mentioned early on, a lot of the literature about kind of the risk-taking was really worried about career risk. So we have a couple measures that I think suggest differences in career risk that we can observe across financial advisors. It's been shown that some firms are more tolerant of misconduct than others. And to put it politely, Egan Saru said there's essentially some firms that specialize in misconduct. Essentially, they want people that are aggressive sales people, and if they do have to pay out some settlements and some fines, that's just part of doing business. Whereas other firms kind of specialize in kind of reputation, and they don't want these types. And so if we cut firms into those that have high misconduct, historical misconduct rates, and employee advisors with lots of misconduct versus those that don't, we see the effects are stronger in those firms that have a more permissive culture. And this even operates at the branch level, which kind of makes sense that it's a little bit stronger at the branch level because the supervisor, each branch has its own supervisor who often has discretion over which advisors to keep and which advisors to fire. There's also a recent paper that Egan Saru put out that showed that essentially controlling for a whole host of factors, it turns out females and other kind of outgroups in the financial industry tend to get punished more severely for the same types of infractions. And so what we see in our data, essentially that translates into the females basically have this kind of higher relative career risk, and we see the effect is mitigated in females, and it's mostly the males that are driving this effect in our sample. Another thing that we wanted to think about was, I've been talking the whole time like this is the advisor making a choice to kind of rip off their client or take some positive action to kind of create some sort of commission. But it could be the case that maybe when I'm under financial pressure, I'm just not as good at my job. And because I'm not as good at my job, I end up not doing poorly, and I don't service my client well. That leads to customer disputes. They get mad because I'm not putting them in the right products. I generate other sorts of disputes with the customers, but it's nothing about me making an active, willful choice. It's me just not being as good at my job. There's kind of a really interesting paper by Matrianer and Nickerson who look at teachers in Texas. And so they look at the teachers that are going into bankruptcy, and they show that their students do worse on standardized exams like during the years that the teachers fall into bankruptcy. And this is essentially like a distraction story. These guys don't get any benefit from being a bad teacher, right? They're just getting distracted by the bankruptcy. And so we want to kind of sort out these two different kind of mechanisms that might be going on. And so we go through each incidence of misconduct, and there's some standardized language that describes this. And so there are things that are clearly active, where the advisor misrepresents, they churn the account, they place unauthorized trades, right? The advisor does some positive action. We characterize those as active. There are other ones where it's kind of negligence or omission of key facts, things that look like passive misconduct. There are a bunch that are very hard to classify or have elements of both, which we remove. But essentially what we find is we find evidence of both things going on, but the majority of the misconduct is active misconduct. So keep that in mind, that we're not kind of saying that both of these go on, but kind of the active is the more important factor here. I don't want to kind of bore with too much with robustness, but a lot of our modeling, it's robust to a lot of modeling choices. One particular thing that we looked at are mutual funds, because mutual funds are a relatively homogeneous product across the country. So one thing you might be worried about is local advisors are selling local stocks, and there might be some, again, local effect that's going on. And so we see these effects just on kind of nationally distributed mutual funds as well, complaints about mutual funds. And I'm going to skip this. So basically, let me just jump to the conclusion that essentially we find evidence of negative house price shocks cause increases in financial misconduct by financial advisors. There's increases in both this active and passive, but essentially most of the action is coming from this active channel. Bigger picture, I think this suggests kind of like the Trading Places story, right? What did we learn? Just go watch the movie, right? People are malleable, and their honesty can change with their circumstances. What are the implications of this? It means for regulators and firms' compliance divisions, it's not enough just to screen new entrants into the industry. we need to kind of understand the financial pressures that they're under to understand kind of the relative risk that they face. And I think it also ties into some of the kind of other papers that we've heard from in this conference and outside about the housing crisis, that there are other kind of non-obvious kind of consequences of the financial crisis. These negative wealth shocks appear to alter behavior, and there's kind of cost of the fluctuation, especially these advisors kind of having higher rates of misconduct against their clients when they're faced with these types of financial pressures. So with that, I will conclude.
So I really love this paper. As you can see, the identification strategy is very tight. There's a lot of robustness checks, and I think any referee that will have to handle this paper will face the daunting task of finding additional ways of checking the robustness of the results. And so I was really struck by the amount of detail and care in the empirical analysis. And sort of you're tackling one of the central issues in the economics of crime. And you know, in your presentation you talk about Becker's theory of crime, his famous paper on crime and punishment. And that's what I sort of have immediately in mind when I think about your paper. And so I opened my handbook of the economics of crime at Freeman's chapter of 99, and I was like, well, you know, what can we learn from prior literature on how to sort of frame your paper in a sort of an even much broader question than the one you're tackling. And so you're looking at the causal question of the impact of the financial advisor's real estate equity return on financial misconduct. And typically, Becker's hypothesis is consistent with the evidence on property crime. There's very little, I think, that shows that, for instance, income or wealth affects violent crime or driving under influence. And there's also, I think, little on white-collar crime as far as I have seen. And so I think this is really an interesting new dimension of the impact of income and wealth on white-collar crime. And I would like to congratulate the organizers. They've sort of found the best fit for a discussion because I realized that this paper is at the intersection of my research on crime with Pat Bennett, where I look at the impact of job losses on crime with Danish registry data, and my research on housing, where I look at the impact of credit on real estate prices, and my research in finance in the accounting review. And so somehow, I never knew that there was such a paper. I should have written that paper. So why is the identification strategy so convincing? Is that the identification is coming from advisors with different real estate, residential real estate addresses, but the same work address. And so you're regressing the misconduct or the change in misconduct. There's actually two specifications, one with the level of misconduct and one with the change on cumulative real estate returns. You've got firms times year fixed effects, you've got financial advisors zip code fixed effect, and you've got the advisors fixed effect. There has been some very substantial progress between the paper I got and the presentation, so I apologize if some of my comments do not apply. I was wondering, because in the current version of the PDF I got, I was wondering how large the firms are, and I discovered that in one of your slides you actually do have the branch. So I was suggesting using the FDIC summary of deposits, which has the geographic location of the branches, to sort of look at within a given firm where the advisors are working. I saw the paper says there's a 6.1% misconduct rate. This is enormous. In the crime data that I'm looking at, I have a 0.4% crime rate, where it is defined in the data as the probability of being convicted for a crime, either to prison, a fine, or a suspended sentence. So I found that an extremely large rate, and somehow that sort of opens the question as to whether this is normal behavior, is this just risk-taking, or is it crime, and to what extent does the filing behavior of the consumers play a role in the reporting of misconduct? Is it that consumers during the boom are not caring so much about the allocation of their portfolio, and then suddenly when the tide goes out, you see who was swimming naked, and sort of that's what I was sort of wondering. So then the identification strategy is very tight, and you know, and sort of I give up there. I'm like, you've done a fantastic job empirically. So I'm just going to give some sort of idea of how we could proceed if we wanted to think about it as a paper in the economics of crime. And Freeman's approach tells us that the benefit of crime on the left-hand side has to exceed the benefit of regular activity. So we've got W, capital W, the advisor's wealth. B is the benefit of financial misconduct. S is the loss of, in case of a successful lawsuit or complaint. And W is the advisor's wage. And sort of, I have a very sort of first dumb question is, does financial misconduct lead to higher income for the financial advisor? If not, then we're facing a sort of a behavioral question is, you know, I'm engaging in financial misconduct even though I'm not getting higher pay due to that misconduct. So question of basically looking at the probability of a complaint or a lawsuit, looking at the benefit of the misconduct and trying to quantify those. Is it really worth the risk, or is it individuals who are risk takers who like risk? The story you have is that the shock to the financial advisor's wealth makes him less risk averse and thus more likely to choose the risky lottery of financial misconduct. So your paper fits completely, I think, in the Freeman story. There is actually a commonality with a paper by Augustin Landier called the risk-shifting hypothesis, where he said when banks in California faced the risk of bankruptcy, well, you know, the downside didn't matter anymore. It was only the upside that mattered, so they increased their risk-taking, and so he shows that as the probability of bankruptcy was increasing, risk-taking was increasing. But in the Landier paper, it's a story about the principal. It's not a story about the agent, and I think you've made a really convincing job at saying that it is a story about the agent because you're controlling for all of those principles fixed effects. And so it sort of brings us to the question of now, in terms of the contract of the financial advisor, how should we structure it? I think there's some very deep implications of your results on that. On the mechanism, the paper describes the impact of real estate losses. Is it the similar impact of a 10% loss with an initial price of $1 million and LTV of 20% and with an initial price of $500,000? I think maybe we want to think about what's the structure of the balance sheet of the household, which is a very topical issue in macro, and sort of think about what is really the trigger of the risky behavior. Is it the absolute value of the real estate equity? That would be more consistent with the Freeman inequality than the cumulative stock returns. Is it the indebtedness? Should we see the same thing for someone who's purchased cash than for someone who's purchased on debt? If we look at, for instance, the data I have on Chicago, where I have all the deeds records for 15 years, we see that the propensity to pay cash dramatically increases during the bust. And so the level of indebtedness varies along the cycle in a way that is really interesting. You could, and that brings us to this point, for a subset of states, you could match the advisor with the exact address. I think you have, with the deeds records, you've got the street address of the property. You can get the latitude, longitude with the Tiger census files that give you the coordinates of the streets. And so you could actually know exactly also the structure of the mortgage because those deeds files through the grant deeds and the deeds of trusts for refi give you LTV, even if it's an adjustable rate mortgage or a fixed rate, and even the indexation mechanism for the adjustable rate mortgage. So now, what would be implications of using the Becker framework, his paper on crime and punishment? There's a first way to see it, which is to see it as a sort of a principal agent issue here, which is that the financial institution could structure the contract to reduce the occurrence of financial misconduct in case the financial misconduct is costly for the firm. Should the agent's contract, just take a sort of a Tyrol approach to this, should the agent's contract be made contingent on his observable housing equity? It's observable, so the contract could be conditional on this. And also the level of the base pay and the incentive slope could be made contingent on his housing equity, his indebtedness, and his real estate returns. And then once we write this on sort of a piece of paper, we realize we're like, well, wait a minute. Should we make the workers' pay schedule more sensitive to complaints of misconduct, or less sensitive to complaints of misconduct when he is highly indebted or he has low real estate equity? And I find the answer is not totally obvious. Maybe empirically we could test the theory and see this. So one of the takeaways from the Becker-Freeman framework is that more risk-averse individuals are more sensitive to the probability of being apprehended than to the severity of the punishment. And so here we could play both on the P, and we could play on the penalty in case of misconduct. I think in the paper you could sort of have a subsection that really spells out legally what are the consequences of financial misconduct. And also you have a measure of financial distress, bankruptcy. How does it affect the advisor's employment prospect? So here I thought, could you run a regression of the mobility of the financial advisor across financial institutions on his real estate returns? So, do we see that they exit the sample, they're laid off, or they find other opportunities? Do we see that they're moving to specific financial advisory firms? Sort of tackling, you've got a lot of fixed effects, and in the labor literature, when we put a lot of those fixed effects, we think about whether the mobility is endogenous to the circumstances of the worker. The second way of seeing the implications of the Becker framework is questions about fiduciary duty, public policy design that also affect both the P, the probability of a successful lawsuit or complaint, and affect the costs of financial advisors' misconduct. And again, we've got this typical insight of the Becker framework for Congress. So we could think of your paper as being both relevant to Congress and being relevant to the financial advisory firms. And that's why I think it's very important that you sort of not undersell, but sell a lot more your results, which are so convincing. So I will say this is an extremely convincing identification strategy. It's a new, rich story. And I think you should expand the mechanisms both on the crime side and on the mortgage structure side, ARMs, LTVs, indebtedness, maturity, and cash purchases. So really great paper, enjoyable read. Thank you.
So William, do you want to?
Yeah, let me, well first thank you. I want to clarify just a couple things and then open it up. One thing, the misconduct that we're talking about here they're relatively, this is Bernie Madoff, like that's not the typical thing. This is taking $50,000 from, a elderly client in a lot of cases. And so it kind of smaller potatoes, but in aggregate, it's as big as financial misconduct or financial statement misreporting or whatever. It's just a lot of really small events. The other thing is 6% is high. is really high. I mean, this is what it is. And there's big regional variations. Like if you go to Staten Island, it's close to 20%. If you go to Omaha, Nebraska, it's like 2%. And so we got to have some follow-up work about this, and then there's some things with labor markets, but there's also the effects. You grew up in Staten Island, you just have higher misconduct rates your whole career regardless of where you go. You grow up in Amish country, you don't. And so I think that's kind of interesting, that there are kind of big variations of kind of ethical behavior that we observe in this industry. But yeah, I agree, it's high, and that's why I think it's interesting. Why is it so high? Go ahead.
Just getting back to the registration issue, so there's this big debate about fiduciary duty, and the industry's working hard to differentiate RIAs from broker-dealers. Can you talk a little bit about that in your data?
Yeah, so it's really hard and really complicated because the same financial advisor doesn't mean anything. That's why we use it in the literature, because it can mean somebody registered with FINRA, somebody registered with the SEC, even somebody registered an investment advisor at the state level. So
They're not insurance.
yeah, well, even some insurance agents are like, financial advisor, nobody's claimed that title, and so that's why a lot of people use that title. But essentially, you can have the same relationship. You could be my client, and across one account, I could have a fiduciary duty to you, and another account, I do not owe you that fiduciary duty because of the nature of the account.
My question is, if you're duly registered, did you see a lower rate? Meaning this effect was reduced because I'm duly registered and I have a hat called fiduciary that sometimes I wear.
No, and one of the PhD students that I worked with previously kind of looked at this and didn't find much, and if anything, you find a higher rate of incidences, but a lot of that higher rate of incidences were people violating fiduciary duty. So it wasn't clear that when you take away these extra responsibilities, that there was much of a difference in how that kind of worked in terms of these types of events that we're talking about.
So I have a question about the sort of way to think about the house price shock. So you're doing the obvious thing, which is, you know, your house price return is negative, that's a bad thing. I think it's a little more subtle than that, because if you're living in a house for a long time and you have adequate income to pay the mortgage, the loss of value of the house is compensated for you by your implicitly reduced housing costs. So you're actually hedged. I mean, for a financially secure person with a long horizon, a house is like an inflation index bond that pays housing services. And you kind of care about the stream of services and not about the current market value. Now that's wrong, however, if your horizon is short, which could be because you're going to move, you're about to retire, you know, you want to sell your house and retire, and then the negative return is very bad for you. Or if you have cash flow problems and you're having trouble making the mortgage, in which case you're going to have to default, and then again it's a loss of value to you, because instead of just selling, and you know, you're going to go into default. So it seems to me that if there were a way to kind of interact the house price change with indicators for either the likely horizon, how long the advisor is going to be in this address, or the overall, you know, income, the state of the advisory business in the area, or how well the firm is doing, or anything like that, it could be a further interaction. And the hypothesis would be that this really matters when your income is low or you're planning to move soon.
Okay, yeah, I completely agree with you. We've thought about some of those types of cuts, but yeah, maybe state of the business, maybe some locality type of things might help us out, but we haven't kind of run that. But that's a good point.
Could you talk a little bit more about the disclosure data, because you're referencing other papers that you've written, so you know a lot about this, but my concern is a sample selection problem. So we've done work in Denmark where we can recognize that Mark has committed a crime, he's been caught for the crime, we know the nature of the crime, we know how long he's been there, but there's a whole bunch of Marks that don't get caught. And so you might argue we're looking at the slow, stupid criminals, not the fast ones. So, you know, I guess one could ask, I guess Bernie Madoff did this for a few years before he disclosed this, so if I'm doing fraud of some kind, why don't I have disclosure fraud? So my concern is, tell me more, I mean... Yeah,
this is a standard question, you know, this is detected fraud. At the end of the day, you only observe the detected fraud, and like, what are the reasons why this might vary? And so, in some ways, the advisor fixed effects pull out kind of the smart versus, you know, the person that kind of can get away with this better than others, because we're kind of looking in the time series there. I think that's kind of one way of addressing this. And then kind of the other issue about like kind of where these customers are coming from, I think helps kind of sort out that if it's just kind of customers being more vigilant in certain periods, maybe vigilant in periods where they're under financial stress too. Sorting this out by looking at customers that are non-local helps kind of concerns, because these customers have common kind of detection rates relative to the advisors who are located in Nevada and in Texas. So you're shocking your Florida, you know, the elderly people in Florida are getting shocked. They're either kind of getting angry or not, but that's common to everybody in Florida, all those elderly complaints in Florida, and it's different, the cumulative returns in Nevada versus the cumulative returns in Texas.
I guess a related question is, the two people you had, I can't remember, Bob and someone else.
Abe, yeah.
Abe, I thought that was a great point. But let's say Abe has got a positive, you know, returns over a period of time. If Abe was a competent financial advisor, he would have gone and bought a house in Florida and used their homestead exemption like every white-collar criminal does, so that they've always got, and OJ, so that they've always got $10 million that they can go live in afterwards. So isn't there a point that we're really, and then he would not have faced problems when he got stressed because of the reduction in his housing later on. So aren't we again, for say that mechanism alone, picking up people who are less competent financial advisors? They're still an important part of financial advisors. I'm not saying this is irrelevant, but it's not the population of financial advisors, the standard sample selection concern.
Yeah, I mean, I guess at the end of the day, anything that sorts away of the observed complaints from, or observed misconduct from kind of detected, that isn't getting pulled out through all these kind of mechanisms. Now we're looking at people who are in the industry, you know, somebody in Texas who's been in there a long time, we're controlling for that. But essentially, we're kind of identifying off the time series in the cumulative return there. So it's got to be something that's correlated. This is an observational setting, right? It's not random. There could be some story of why people that move to Vegas are better at setting up these things ahead of time because they know the shock's coming. I can't rule out some story like that, but I don't think in the aggregate that that's going to be that much of a percentage of what we're observing.
Well, we don't know. We don't know.
And on the other hand, though, there is a lot of evidence that there are a lot of incompetent advisors. I mean, there's a neat paper where they show, you know, these advisors are putting their clients in all these bad things, and then they look at the advisor's portfolio, they're just copying their own portfolio. So I think, you know, there's room for that story. You know, how much of that is, I can't empirically say, but I think a lot of the fixed effects pull out a lot of commonality, and so the stories have to be kind of quite complicated about how I'm anticipating these shocks and setting these things up, and just how much your beliefs of those types of things that I can't possibly rule out drive it, kind of rules out how much of the effects coming from that versus kind of the story that I'm trying to sell.
So I have this question. Since you're using zip code variation in house prices, should you be concerned that maybe you're capturing not, like the effect you're capturing is not because of decreases in advisors' wealth, but some like local neighborhood thing, which is correlated with the zip code level house prices, right? So maybe the area is really going down in some sense, and you see house prices are going especially down. And then advisors do these things, but not because, or like you have two mechanisms. Maybe one is because of their own wealth, but there is something else. Maybe their job, you know, prospects are worse now, or something unobserved local going on, which can also drive the same, you know, same result.
I hope most of my zip year and zip rancher effects pull out most of that type of stuff. And to me, the out-of-state complaints are pretty compelling because those survive those types of stories. There's no reason for kind of their customers who are in kind of other places to be driven by that. And we've excluded, like, you know, some cities are on state lines, and we've excluded like neighboring states and stuff like that in the result state. You know what I'm saying?
I want to say, is this effect worse in larger firms or smaller firms? I know large firms invest a lot in compliance departments. You know, UBS, Morgan Stanley, Merrill Lynch. Do you see less of that in those very large firms?
That's an excellent point. We should actually look at that. So, I mean, it's somewhat suggestive that the firms that have higher misconduct rates have some of this, and usually the big
smaller or larger?
They have larger effect, high misconduct rates.
Are these large firms?
Not, the largest firms aren't kind of the super high misconduct. The wirehouses are kind of in the middle pack. The small firms basically really bifurcate though. So I think that's a particularly interesting sample. There's small firms that kind of just start off. We actually did a little bit of consulting for one of these local guys. And like, I mean, they have no clue. Like, you know, they're used to selling, they're salespeople that start off these little firms. They just do the minimum compliance. And so like, I think this type of stuff kind of can be more pervasive at these smaller firms because of the lack of checks, like you see.